today's video, which is called Stormy S&P 500 September, there should go a question mark, of course, but I will answer this question within this presentation. Also, I will be covering gold and what new I have prepared for trading signals subscribers. You are already familiar with the intraday channel for stock trading, whereby I comment on market moves, sectoral insights, intermarket, currencies, and so on and so on. That gives inspiration for stock market calls. And I will be launching as of tomorrow a similar service which would be provided free of charge to those who support my quality analytics within the trading signals. For starters, it will be about gold, silver and oil. It will be probably less detailed when it comes to market calls than the stock market equivalent, but it will cover the intraday perspectives that many of you had been asking me privately within Twitter or within emails. So this is something to fill the intraday gap so that you have more than the daily updates and continued Twitter updates when it comes to market moves within real assets. So, the goal with this quick video is to prepare you, of course, not just for the day ahead, because I will be discussing a larger stock market perspective. Make sure that you are subscribed on my site and that you follow me on Telegram as well. If you decide, as many of you had done so, to rely solely on Twitter, please combine it with Telegram for reliable delivery of those notifications, and make sure that you read anyway those daily analyses, because that's the basis, alright? So let's move to the big picture as regards the stock market and to the larger economy. Well, all the economic data from manufacturing to job market still paints a picture of lukewarm, okay, not accelerating, but still kind of a Goldilocks economy, some would say. In any case, it's not crashing, and because inflation isn't surging that much above market expectations, and market is still very tolerant of those still relatively stubborn inflation expectations, which would become more obvious in the quarters ahead. In United Auto Workers strike, the wage pressures are not really over, but for now it does not require more Fed hikes. And Friday we saw a perfect example of dialed back odds for a September rate hike, resulting in a stock market spike that was sold into, and rates went up, putting corresponding pressure on tech that the market more or less withstood Friday. And today we got a bit of an upswing and rejection precisely at my 4.529 till 4.535 ES zone. One point worth noting is, of course, the still expansive fiscal policy that is negating the restrictive monetary one, with rates being quite in the real rates being quite in the positive territory for now, which coinciding with some global liquidity uptick driven not only by China, and again working at odds with the Bank of Japan yield control move that sparked greater fears of rising rates. This helped to stabilize stock market prices in the second half of August. Bears simply missed a good opportunity that I would cover in the upcoming slide. September, though, is quite seasonally weak month, and in spite of the positive seasonality to open tomorrow, odds are that the intermarket picture as I see it this moment, and as I had been updating chiefly the intraday signals and Twitter communities, would work against too much of an appreciation. Out of the bigger picture, staying with this because I'm too much diverting to the short-term picture, but it would make still a pretty good sense for you, is that I'm not looking for any kind of a China crash. The year would conclude with better than 4, maybe 4.5% GDP growth, and the economy and stocks with the step-by-step stabilization moves would pick up, and the US recession that I had discussed good 3 weeks ago as regards timing, the arrival, may either arrive very late this year, meaning maybe even December, because as the savings are running out only now for even the latest best standing from the point of view of income cohort, or in the first half of next year. For now, it's still the lukewarm economy that is not rolling over and that does not require more Fed tightening, meaning this is taken as a Fed pivot. No adjustments to forward earnings, no adjustments to valuations, but thus far the behavior is as befits such periods, and that would mean that if it holds true and the stock market following maybe earlier half of September gyrations, hard to tell for now, but it would coincide with the forthcoming move in yields higher that I still see as not having played out totally. That would mean that tech and financials would do rather well. Maybe industrials would slow down a bit, but materials would do fine, and of course energy would do fine. Probably as well discretionaries would not disappoint, but I'm having a question mark over select few. But still, if XLY does well, it means that the greater headwinds for the stock market would arrive only later on, and it's only with the onset, officially recognized onset of recession, that the greatest moves to the downside happen. For now, okay, I will leave this comment for the upcoming chart and finish the last 3 bullet points here, and that's the yield curve. It's not the best timing tool for the arrival of recession, but you know, it would have to be already starting to steepen to normalize, which would be the fact that would herald an onset of recession. And it's not doing that. It's still moving in the month-long range, deeply inverted, but it's at the upper end of that range, so it pays watching this 10 over 2 year spread. When it comes to yields, the short-term ones are of course vulnerable to retreat, and that rhymes well with not only relegated to the dustbin September rate hike, but with the November one not being totally discounted as the most likely. I'm still of the opinion that the Fed would needs to hike in November, which is not the majority opinion right now. I think simply that the oil prices and oil product prices would translate into more of inflation pressures, and that the job market, for all the decline in jobs and for all the challenger data, would not be deteriorating fast enough in real time, and the upcoming danger of recession would not be recognized for what it is. The market psyche is still in recession avoided, soft landing achieved, and it would take more than a couple of weeks to revert that. So that's why I think that still the longer yields would still rise for a while, the 10-year probably to 4.25, but would be retreating for all the fresh debt issuance. I'm looking for 10-year, 30-year to dip these yields, meaning those treasuries, TLT, TH, would be going up from here. And if you open the Friday's chart of TLT, the lower note and volume, it's pretty obvious that the downside is not reaching too far, and that it would turn up this treasury bond fund. So let's move into stocks. It's a daily perspective, so let's start with the very short-term view as regards tomorrow. Following the failed run into the earlier mentioned resistance zone, I see quite a lot of backing and filling around 4.515. It will be probably broken to the downside, and 4.508 looks a reasonable target. Let's see whether the sellers gather enough strength there, but as I have been highlighting in the big picture view, the expectations are very tempered. For 492 isn't probably going to give way tomorrow. It's largely a battle of tech and communications versus yields. These are the most vulnerable. Discretionaries would still do kind of better than these two, especially if tech decides to listen to yields, which it did not completely do today. Financials and Russell 2000 would be my proxies for risk-taking flavor, maybe together with industrials. Larger picture, the very promising August August decline was a missed opportunity for the bears. The 4.360s hadn't been anyhow strong technically support, and the price had already drifted way too higher above the blue exponential moving average that's capturing sharpening 50 day moving average has drifted too far higher, yet the last 2 days indicate a clear trouble with extending gains. Yet it's a question of catalyst, which I don't see one as materializing this week. So probably it would be up to yields and the dollar that is still rising. A technically sound target for the decline would have been for 225, but as said, it hadn't been reached, and the time for breaking back below the blue exponential moving average is kind of getting shorter. The more we stay building above it, the more troubled for the sellers it would get, and that means that more of the downside would have to wait for the sharp unexpected deterioration in economic data. One more factor when it comes to the retreat in yields that I foresee is to what degree would it support tech? Would it be as a result of rush into safety because the stock market is having troubles and it would cover tech shares as well, or the Magnificent Seven? That's the big question for September. That's why I'm modestly leaning towards the bearish side at the open. Yet I'm very much aware of the past track record of missed opportunity in August and still largely not supportive macro environment for a steep decline of say 150 or 200 points. It still sounds too much without a clear justification, and when it materializes, it would be very easy to observe and jump on for a lower risk reward with a better risk reward setup. For now, the odds of a decline are somewhat better than 50-50, and chiefly it counts upon the difficulty of extending gains, and as well on the troubled formation in Russell 2000. If you open the chart daily, it's almost with an imperfect upward leaning trend line. You could almost draw an inverted head and shoulders, with 190 being a strong resistance, and Friday IWM had been badly sold into the upswing. So that's as well a short-term factor not inspiring confidence. So that's why I would say that the short from here has maybe 60% odds only, maybe 55% odds, hard to say, but the coming week, including its seasonality effect of selling May and go away, don't come back after Labor Day, whether it holds true, this saying would show more about what's ahead for the stock market at large, because I would like to see risk taking on the fringes, be it retail, be it transportations, be it Russell 2000. I would like to see these pick up, and not that the ES upswing would be a matter of tech only. So that covers the stock market part, and now let's move to gold and silver. You are surely as well already familiar with this daily chart, which I had been covering already today within the Trading Signals Telegram channel. That for now would be covering gold, silver, oil. If you are a Trading Signals subscriber as of now, just mail me, tell me your Telegram username, and I will add you to the premium channel. The brief correction is here, and the long upper knot on rising volume is just one sign that we have a bit further to go, both in time and in price, in this correction. You are surely familiar how I was advising on the way down, where approximately the bottom would be. Okay, it undershot by almost $15, but since then prices have neatly stabilized. That was still in the pre-BRICS week, and we have seen a couple of good opportunities to add to positions, such as the last red candle, still below the blue exponential moving average. That was the one when I advised you in real time that this was a good one to be bought the very same day, well before the upswing was restarted. And now we are undergoing similar kind of consolidation. Note how well gold is performing against the rise in yields and the rise in dollar. I still say that this up leg has further to run than 1980 in December contract. Maybe this price would be approached in XAU USD as well, which means that the up leg top would be those $10 to $15 above in futures. Silver, though is in a nice accumulation point, it is more pessimistic than gold. It is well below 24.70 in futures, and it's even underperforming copper, which is kind of underpinned with the China crash stories dying slowly down. So that's what I see for precious metals ahead. Their upline would be powered precisely by the retreat in yields, because this is still remarkable performance if you consider where inflation and inflation expectations are at the moment, and where gold had turned up and is readying to extend gains further. So summing up and gently closing this long presentation to welcome you back after the August hiatus on YouTube. I'm pretty sure you are familiar with my journey beyond the trading story, the professional one. Beware of impersonators that are again popping up. And obligatory disclaimer: thank you for liking, commenting and subscribing, and have a nice rest of the extended weekend.